presentation is going to focus on the definition of bonds and what they represent. If you would like more details about bonds, please refer to your segregated fund module, section 1.3.4. We're going to start with a quick overview of bonds and what they represent. And really, a bond represents a loan between a borrower and a lender. And typically when you think of loans, you think of a financial institution lending money, for example, in terms of a mortgage, to a consumer, someone who's buying a house or would like to purchase something. And this is very similar when we are talking about bonds. The difference is that the borrower is actually the issuer, and the lender is the investor. And so the lender would be a client, and the borrower would be, for example, a company looking for capital. Now, in exchange for this loan, just like with a mortgage, the borrower or issuer promises to repay the principal, the amount that's loaned, with a fixed amount of interest over a set period of time. A loan or a bond can also be referred to as fixed income securities, or as debt. There are two different types of bonds. The first is a corporate bond, and the second is a government bond. So, for example, like the Government of Canada. Investor protection is available with bonds, and it's provided by the CIPF. And the CIPF really only provides insurance if the dealer becomes insolvent, and it is up to a maximum amount. Next, we're going to discuss bond terms and the maturity date. The maturity date refers to the date that a bond comes due, and on this date, all the principal is repaid, as well as any interest that might have been due up until this point. Usually, bonds vary between 1 to 30 years, and they are separated into three different categories: short-term, medium-term, and long-term. A short term generally tends to be 3 years or less, and a medium in between 3 to 10 years, while long-term bonds generally are 10 years or more. And with long-term bonds, you do also have the added benefit of a higher interest rate. And so the investor does get some more money for locking their money in for longer, or some more interest rather. The interest is actually the coupon rate, or referred to as the coupon rate when talking about bonds, and it is paid 2 times a year. It is taxed as interest income, and there is no preferential treatment. Now, how much interest you get from a bond is actually based on the credit quality or credit worthiness of a company. So the more financial trouble or problems that a company might have, the more risk that the investor is taking on. Now, bonds do vary between junk bonds, which are the most risky, to AAA bonds. In this slide, we're going to talk a little bit about pricing and where you can actually purchase a bond from. So there are two different ways that investors can purchase bonds. One is through an IIROC licensed advisor, and the other is through a limited market dealer. And either one has the opportunity to sell them at any time. There are some terms that are affiliated really only with bonds that we're going to refer to when we're talking about pricing. The first is the face value. The face value, or the par value, is really what the investor is paying. When the price goes up, or when the price goes above the par value, it's said to be trading at a premium. And when the price goes down, it's said to be trading at a discount. Now, when these bonds are sold, it is possible that there can be capital gains or losses at that time. There are several risks associated with investing in bonds, and the first is an interest rate risk. Next, reinvestment risk, inflation risk, credit risk, and liquidity. The types of bonds available vary between a GOC, which actually stands for a Government of Canada bond. And the Government of Canada is really the largest issuer of bonds. They guarantee their bonds. They're more on the safer side and less risk for the investor. They pay an interest semi-annually. Provincial bonds are highly liquid, which means that they're easily bought and sold. Municipal bonds vary in credit rating, really depends on the municipality, and there is a large secondary market for municipal bonds. The corporate bond has its risk associated on the company's credit worthiness, so we did sort of just discuss that in the previous slide. And the money that they get is usually used to shore up their financials or to expand. The last type of bond is a foreign bond, and the credit worthiness of a foreign bond is based on the country's political and economic stability. The last piece that we're going to go through are actually the disadvantages and advantages of investing in a bond. I'm going to start off with the advantages. And the biggest advantage is there's a lot of variety in bonds. So there's variety in the credit rating, there's variety in the type of issuer, and there's also variety in the terms available. The next is the repayment guarantee, or guarantee to get back your principal when you invest in a bond. Advantages, there really are only two. There's a significant lack of transparency when investing in bonds, and the sale price can trigger gains, as we discussed earlier. That's kind of the gist of bonds. As I said, if you're looking for more details about bonds, please refer to your book 1.3.4.